The year 2008 witnessed a financial earthquake, the subprime mortgage crisis. This catastrophic event was not just a blip on the radar. It was a seismic shift that altered the landscape of the global economy. The roots of this crisis can be traced back to the early 2000s when the housing market was booming and financial institutions were handing out loans like candy. Homeownership was being pushed as the American dream, and people were eager to buy even if they couldn't afford it. This crisis shook the global economy, leaving millions jobless and questioning the very foundations of the financial system. The ripple effects were felt far and wide, from Wall Street to Main Street, and from the United States to countries around the globe. Businesses shuttered, families lost their homes, and the unemployment rate soared. The human cost was staggering, with lives upended and futures thrown into uncertainty. It was a tale of reckless lending, complex financial instruments, and a housing bubble waiting to burst. Financial institutions, driven by greed and short-term gains, engaged in risky lending practices. Subprime mortgages were given to individuals with poor credit histories, and these loans were then bundled into complex financial products that few understood. The housing market, inflated by speculation and easy credit, was a ticking time bomb. The crisis exposed the fragility of a system built on risky mortgages, complex financial products, and a lack of regulatory oversight. Regulatory bodies failed to keep pace with the rapid innovation in financial products, and the lack of transparency allowed risks to accumulate unnoticed. When the bubble finally burst, the fallout was swift and severe. Financial institutions that were once deemed too big to fail found themselves on the brink of collapse. The aftershocks of this crisis continue to reverberate, reminding us of the importance of financial responsibility, transparency, and robust regulation. Governments and central banks around the world had to step in with unprecedented measures to stabilize the financial system. Bailouts, stimulus packages, and regulatory reforms were implemented to prevent a complete economic collapse. The lessons learned from this crisis have shaped financial policies and regulations to this day. The world watched in disbelief as financial institutions crumbled, governments scrambled for solutions, and ordinary people faced the devastating consequences. The crisis served as a stark reminder of the interconnectedness of the global economy and the need for vigilance in financial practices. It underscored the importance of sound financial management, ethical lending practices, and the critical role of regulatory oversight in maintaining economic stability. As we move forward, the lessons of the subprime mortgage crisis remain ever relevant, urging us to build a more resilient and transparent financial system. At the heart of this crisis were subprime mortgages. Imagine a ladder where each rung represents a borrower's creditworthiness. Prime borrowers with excellent credit occupy the top rung. They get the best interest rates because they pose the least risk. Subprime borrowers, however, sit on the lower rungs. They have poor credit histories, making them riskier borrowers. Lenders offered them subprime mortgages, but with higher interest rates to compensate for the increased risk. These mortgages, packaged and sold as complex financial products, spread like wildfire, fueling the housing bubble. The subprime mortgage crisis didn't happen overnight. It was a perfect storm of factors brewing for years. Low interest rates after the dot-com bubble burst made borrowing cheaper, encouraging more people to enter the housing market. The demand for mortgages, especially subprime mortgages, soared. Financial deregulation in the preceding decades allowed for riskier lending practices and the creation of complex financial products. The belief that housing prices would continue to rise indefinitely created a climate of complacency. This combination of factors set the stage for a crisis of unprecedented proportions. One primary cause was the relaxation of lending standards. Lenders, enticed by the booming housing market, approved mortgages for borrowers with poor credit histories and low credit scores. These borrowers were often offered adjustable-rate mortgages, or ARMs. ARMs initially had low interest rates, but these rates reset to much higher levels after a certain period. When housing prices plateaued and then began to fall, many borrowers, especially those with subprime ARMs, found themselves unable to make their monthly payments. This triggered a wave of defaults and foreclosures, sending shockwaves through the financial system. The players who were involved. Multiple players contributed to the crisis. Mortgage brokers, eager to earn fees, pushed borrowers into loans they couldn't afford. Investment banks packaged these risky mortgages into complex securities and sold them to investors worldwide. Rating agencies responsible for assessing the risk of these securities gave many of them top ratings, misleading investors about their true risk. Regulators, often asleep at the wheel, failed to adequately oversee the financial industry and curb the risky lending practices. This collective failure of responsibility created a system ripe for collapse. Global fallout, the crisis spreads. The impact of the subprime mortgage crisis quickly spread beyond American borders. As mortgage-backed securities began to default, financial institutions worldwide holding these toxic assets faced massive losses. The crisis triggered a global credit crunch as banks became wary of lending to each other. This lack of credit availability stifled business investment and economic growth. Stock markets around the world plummeted as investors panicked. The interconnectedness of the global financial system meant that the crisis in the United States quickly morphed into a global recession. Expert voices, opinions, and forecasts. In this section, we delve into the myriad of opinions and forecasts that have emerged in the wake of the financial crisis. From seasoned economists to financial analysts, the spectrum of viewpoints is as diverse as it is insightful. Experts have offered various perspectives on the crisis and its aftermath. Some believe that the crisis was an inevitable consequence of systemic flaws that had been building up over decades. They argue that the warning signs were there, but were largely ignored by those in power. Some argue that the crisis exposed the dangers of deregulation and the excesses of Wall Street greed. They point to the rampant speculation and risky financial practices that were allowed to flourish unchecked, leading to a bubble that was bound to burst. Others point to a failure of risk management and a lack of understanding of the complex financial instruments being traded. They believe that many financial institutions were simply not equipped to handle the sophisticated products they were dealing with, leading to catastrophic losses. Many experts agree that the crisis highlighted the need for greater financial literacy among consumers, who should be more cautious about taking on debt, especially for housing. They emphasize the importance of educating the public about the risks and responsibilities associated with borrowing and investing. Most importantly, the crisis underscored the need for stronger regulation and oversight of the financial industry to prevent similar crises in the future. This includes not only stricter rules and guidelines, but also more robust enforcement mechanisms to ensure compliance. The goal is to create a more stable and resilient financial system that can withstand shocks and protect consumers. Lessons learned: preventing future crises. The subprime mortgage crisis taught us many valuable lessons. First, unregulated financial markets can pose significant risks to the global economy. Second, transparency and accountability are crucial in the financial industry. Third, consumers need to be educated about financial products and the risks involved. Finally, strong regulatory frameworks are essential to prevent excessive risk-taking and protect the financial system from future crises. Conclusion: a turning point in financial history. The subprime mortgage crisis was a watershed moment in financial history. It wasn't just a financial event. It was a social and economic upheaval that affected millions of lives. Homeowners lost their properties, and entire neighborhoods were left desolate. The ripple effects were felt across the globe, shaking the very foundations of the financial world. It exposed the vulnerabilities of a highly leveraged and interconnected global financial system. The crisis revealed how deeply intertwined financial institutions had become, and how a failure in one part of the world could trigger a domino effect, leading to a global financial meltdown. The stock markets plummeted, and emergency meetings were held to contain the damage. The crisis led to stricter regulations, increased scrutiny of financial institutions, and a greater awareness of systemic risk. Governments around the world had to step in with bailouts and stimulus packages to stabilize the economy. New regulations were introduced to prevent such a catastrophe from happening again, focusing on transparency, accountability, and risk management. While the road to recovery was long and arduous, the lessons learned from this crisis have the potential to create a more stable and resilient financial system. The economic recovery was slow, but it laid the groundwork for a more robust financial infrastructure. Efforts were made to rebuild trust and confidence in the financial markets, ensuring that the mistakes of the past would not be repeated. The challenge lies in implementing these lessons effectively and remaining vigilant against future threats to global financial stability. As we move forward, it is crucial to stay alert and proactive in identifying and mitigating risks. The future of global finance depends on our ability to adapt and respond to new challenges, ensuring a secure and prosperous economic environment for generations to come.